Mr. Greenwood.
Geoff.
Ross.
We've known each other such a long time.
Yes.
Look, you, apart from having built Wilson Asset Management,
Yes.
and the Future Generation Fund, why along the way have you also become the great advocate for individual investors in this country? What happened there in your mind to suddenly go and take on some of these causes?
I suppose, if we go all the way back, when I set up my funds management business, the whole logic, I had a choice. I could have sat at home and managed my own money, or if I put my money with other people's money, then I'd be seen as an institution and I get access to companies that the general public don't get access to. So that was my logic. And as we've grown our business, then we've ended up having a lot of high net worths and retail investors, and they're part of our community. So I was always taught growing up, it's important to sort of support your community. So we've always found it important that we stand up for our retail investors. Now we've got 130,000 retail investors managing $5 billion that we manage on their behalf. So they've trusted us with their money, and we think it's part of our obligation not only to perform for them and make a difference for them in terms of from an investment perspective, but also make a difference for them in terms of standing up for what they may not be able to stand up for.
Okay, so there's a couple of things that really spring to mind. One of them obviously is the campaign on changes to dividend imputation. Now that was clearly almost a raison d'etre for you to really take on government, be very public about that, but that can sometimes come at a cost.
Yeah, and over the last, say, 25, 26 years, wherever we think a company hasn't been doing the right thing by shareholders, then we've stood up for shareholders. It just happened to be, and in terms of governments, and it doesn't matter whether it's who's in government, whether it's Liberal or Labor, if we don't think they're doing the right thing by what we think by the by retail investors, but also by Australia, then we're prepared to stand up for it. And back in 2018, 2019, when the opposition, the Labor opposition then was talking about doing something that was significantly unfair. It was disadvantaging some people significantly, and it just wasn't equitable. It was illogical, and so we stood up against that. And it can be a cost, and it was quite brutal. And everyone, I remember around that time, a lot of people saying, "Look, why are you doing it? Labor's going to win the election." So you're thinking, "Oh well, probably going to have a tax audit and an ASIC inquiry if Labor win," because we're fighting against one of their policies. And in the end, in the end they didn't win the election, but and it was fortunate that we could prove to people that it just wasn't equitable and fair.
Okay, so a couple of times you've said there about retail investors, but there's something else right now you're campaigning against, and that is about who is a wholesale investor and who is a retail investor. Now the government is seeking to change the rules in this area, and many people suggest in some ways is going to make it tougher for a person to be classified as a wholesale investor. Again, why take that on?
Yeah, and that's a perfect question, because logically we're a wholesale investor, so it's in our interests that retail investors can't participate in our...
You mean I'm all right, Jack, pull up the ladder, as it were?
100%, yeah. But from our perspective is, we've got the people we manage the money for, like 130,000, and in Australia there's probably 8 to 10 million investors in the stock market in Australia. So we want to make it, we've got to do what we think's right and what's fair. And we think if a company is listed on the stock market and it's raising capital through a placement, then all shareholders should be able to participate. Is it fair to allow ourselves, a wholesale investor, to participate, and then as soon as we get the shares, we can sell them to the retail investor at a higher price, where the retail investor doesn't get the opportunity to participate? It's just totally illogical. And the numbers, like over the last 4 years, retail investors have missed out on, by not being able to participate, $15.7 billion. Like that is just...
So that's real money in their pockets?
Well, unfortunately not in their pockets, in wholesale investors like our pockets.
So then there's also the other side of that for who is a wholesale investor, who is a retail investor. A lot of retail investors cannot invest in new ventures that come up because it's only exclusively for wholesale investors. But if the bar is raised as to who is a wholesale investor, then it means that maybe some people are going to miss out on new growth opportunities.
New growth opportunities, and those companies are going to miss out on capital. And so therefore, like we focus on companies listed on the stock market, but unlisted companies, that need to raise capital, and venture capital companies that are funded with venture capital. Some of them, initially it can be, so high net worths that put their money in, and if your high net worth isn't high enough, then you don't get the opportunity. So it's a virtual circle that can be quite negative.
And this is a country that's trying to become the innovative country. So that means really this is almost suppressing innovation in some ways.
100%. Yeah, 100%.
Okay, so then the other campaign that you've worked pretty hard on is the superannuation caps. The government's saying that people with more than $3 million in their superannuation fund should pay higher taxes. Now, governments, I've always said, can tax us how we want and we can vote how we want, but that's what they do. But there's a couple of things there. That $3 million is not indexed, and it also takes into account unrealised capital gains. Just explain why that's something you've fought hard on.
Yeah, initially when they came in and announced it, the $3 million cap, which is, they announced it the first day, and we really didn't we weren't overly concerned about that. But then the following day they realised that some of the industry funds and big union funds weren't able to, they weren't going to be able to administer it properly. So then the second day they came out and said, and it's going to be, the tax is going to be on unrealised gains. And then we thought, well, that is just unfair. Because you've got a lot of small businesses have their business in their self-managed super fund. We've got instances, a number of our shareholders we've spoken to, one's a farmer, fell on tough times back in 2000 and during the GFC, 2008, 2009. Ended up, the banks, owed money to the banks for his farm, had to sell half his farm. And then he's still on the farm. The other half of his farm he put in his super fund because he thought he'd be safe there. Unfortunately, the value of the farm's gone up significantly, so he'll have to, if this legislation comes in, you're taxing a pretend profit. It's not there. And he'll have to sell his farm to pay the tax.
There's some theory that every super fund is the same, that every super fund is like an institutional super fund, mixed up with cash, shares and all. But most superannuation funds, especially for small business people, is wrapped up either in their business or property assets. So they're often illiquid, so they don't just have the spare cash sloshing around to pay a tax on something that has not yet been realised.
But the whole concept is of taxing unrealised gains in this pool of trillions of dollars. And there's nearly $1 trillion in the self-managed super fund structures, which you want them to take risks. So why would, if you got your money in a super fund and you're going to be taxed on a capital gain that might never eventuate in a high risk industry, then why would you ever invest in it? Because say if the value of the assets over June 30 go up by $5 million hypothetically, and then the next week they go down by $4.5 million or $5 million.
But you've already got the tax assessment.
But then you have to pay tax. So what it'll do effectively, it'll discourage people from taking risk. So they're better off just putting their money in the bank and getting interest. And if we want to be the smart country, then that's just so illogical. So that's the unrealised capital gain part.
So just as a broad philosophy though, are you concerned that some of these campaigns that you run become disincentives for people to become investors in private capital, in the share market, simply because they can see that there are risks coming from government that might be disincentives to become an investor? I mean, we don't want to go back to the country to be the country that leaves all their money in the bank.
Yes, no, I mean, it is a risk. It's a risk, and unfortunately, this government seems to be doing a lot more of it than the previous.
Geoff Wilson, thanks for your time.
Thanks, Ross.